Talk about something nobody really likes to talk about, and you hear the term a lot in our industry, and that is margin calls. Okay. I know nobody wants to hear about those, but it's a fact of our industry just because of the high degree of leverage that can take place. So, what does that mean when you go on a margin call? It means your net liquid value has decreased in value, and you're going to have two choices: either add more funds or reduce your position. So, let's go through an example of a margin call. Let's say the margin requirement, let's say, was 100,000, and this is just an example. I'm not using a real world. So your margin requirement initial was 100,000. Okay. So you have 100,000 initial, and let's say hypothetically you start out with 150,000 in your account, but the initial was 100,000, and the margin call or maintenance is, let's say, 90,000. Okay. Maintenance. So what happens is if your net liquid value mark to market of your positions goes below 90,000, you will initiate a margin call in which you have two choices, and it could be even an intraday margin call. And certain FCMs have different rules for how they handle margin calls. Some FCMs will allow you to go on like a 3-day margin call and be a little bit looser with you, and other FCMs will be a little bit more strict with you and want to know exactly what you're going to do by end of day, and they may push you to either reduce, and they have the authority to have you reduce or add more funds during the intraday, of which they're going to want confirmation that that wire is on its way. And again, it's just going to have to add more collateral. So you got two choices: reduce your position size by removing some of the contracts and take some losses, or two, add additional funds. So if the account NLV goes to say 89,000, okay, you'll initiate an $11,000 margin call, okay, which is not that big of a deal in this scenario. So you initiate. So you need to bring your account NLV above 100,000. So you would have to send in $11,000. Now let's say your account value went down to say 75,000 NLV. Okay. Then you're going to have to send in $25,000. Okay. Okay. $25,000. Now, I will say, just from my experience, most FCMs, if you have a $10,000 to $20,000 margin call, they're not quite going to be panicking or freaking out. They're just going to want to see you take some course of action. I've got one FCM that'll kind of let you go for 3 days. I've got another FCM I clear through, which is going to be a lot stricter. They're going to want to either reduce or get additional funds sent in. And realize a lot of our industry is established trust. They want to see that you are going to either send more funds or reduce your position. Okay. If you don't do those two things and you violate that trust, they may just go ahead and close your account. So realize there's a lot of trust involved because of the high degree of leverage in our industry. And once you build up a name, part of our KYC, know your customer, we all kind of know who's who and what's what. They may let certain clients do certain things that they won't do with a brand new client. So realize a lot of this has to do with your reputation and that trust factor, one of the key pillars in the futures industry. So if you send in that 25,000, you're good to go. Okay. But if you were to get in this situation and you had a 25,000 margin call, I might make a recommendation. Hey, send in 50 grand to cover it if you want to hold those positions. And it's just straight math. It's nothing personal. No one's upset. These markets are volatile. They can move very quickly. But effectively, you got to really understand what you're buying and understanding those leverage ratios. You got to really do. It really is quite shocking to me how many people would be trading these markets and not really understanding the specification and how much they're really controlling in these markets. Okay. But effectively, that's how a margin call works. Effectively, when your NLV goes down to a certain value below that maintenance part, you will initiate a margin call. You may even initiate an intraday margin call because it goes way below that maintenance, and they want to see some action taken because the markets may be moving very quick. Now, I do have a lot of clients that have deep pockets. They meet those margin calls, no big deal. Okay. I have other clients with not such deep pockets. They'll go ahead and reduce or go ahead and take that losses and try to trade their way out of that position. But effectively, that's how a margin call works, or the basics of it. So just realize, like I said before, there's a lot of trust involved. We want to see you perform, and we want to make sure that you're keeping track of your account as well. That's the other biggest thing too. We don't know, with the general public, we don't know if you're on a plane or if you're even watching. So they just want to know that you are watching your account, because at the end of the day, I carry risk, the FCM carries risk, and the exchange carries risk. And so there's that big word I use a lot: trust. So I hope you learned something new. Take care.